Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 217, Managing Risk. Jake, thank you for joining me back on the show.
Yeah, thank you, Jake. Always happy to be here.
And I know you've got a lot going on in your personal life. Do you want to share that with the millions of viewers out there?
Sure. Yeah. So doing quite a bit of home remodel right now.
Another
I
one.
finished my upstairs bathroom probably about 3 weeks ago. And unfortunately, I now need to redo the downstairs bathroom due to some leakage. So getting that fixed, and then I got a new car recently too. So a lot of exciting things going on.
Yeah, you got a lot. And credit to you. How long did you drive your old car?
Since 2014.
So you got 8 years out of it.
Yep.
And you bought it used, right?
Mm-hmm.
Or you got it used. And good for you, Jake. So you got some good mileage on that. And so you got a new car coming, you got a new bathroom coming. Lots going on in your life. We've been busy here at Falcon Wealth Advisors. I know you've been busy meeting with clients. Also recently, it's been a couple months now, but you're also a certified financial planner. Maybe you can go into a little bit of that for our audience that doesn't know that.
Sure. Yeah. So certified financial planner is probably the gold standard designation for someone in my role and in the industry. Essentially, it covers all sorts of various topics: estate planning, tax planning, investment management, insurance planning, things of that nature. So it's a wide variety of topics, and it goes fairly in depth with them. So it was a lot of fun studying for it and a lot of fun passing it, as you can imagine.
Yeah. And one of those topics is insurance, right? And so that's today's topic of our show is, and maybe it is a surprise to some people, but part of managing risk, today we want to talk about insurance. And we want to talk about the pros and cons with insurance. I am a licensed life insurance agent, even though I don't really sell any insurance products, but I'm glad I have that license because I've taken the time to study and understand that industry. Jake, I think you have do you still have your life insurance license as well?
I do. Yep.
So both of us are licensed life insurance agents, even though nowadays we really refer a lot of that business out to other professionals. And not because we necessarily don't want to deal in it for our clients. It's more that we're not doing it every day. So I'd much rather refer it to somebody who is in that world and constantly working with the different carriers and going through those processes versus us. And also, as a fiduciary, I don't want to have a conflict of interest in, pitching somebody a product where I get paid a commission on it. So again, you and I both understand insurance, and we definitely talk about it a lot with our clients. And today we wanted to talk about some ways that they should look at managing their risk. And to kick it off, Jake, I'd like you to start, if you don't mind, into the subject of life insurance. It's probably the most common way that people think of insurance, or one of the most common ways. So why don't you kind of explain what life insurance is and who should have it, or what it should be used for, I guess.
Sure. Yeah. So life insurance is a very common product. Essentially, if you pay a premium to cover, it's essentially a death benefit. And what it's used for is if something were to happen to you, and it's there for various things like paying off existing debt, funeral costs is something. And then I think more importantly, it's replacing your income. So if you were the main income earner in your household and something happened to you, that death benefit would then go in place to help fund the lifestyle expenses for those that are surviving you. So it's something that especially young families should take a look at, especially if they are, they have higher earning income, but they don't have a lot of assets yet. It's something that they should definitely take a look at to make sure that they're covering all their bases if something happened to them, right? They want to be able to provide their heirs the same lifestyle that they have been accustomed to. essentially.
Good, thank you. Yeah, and it's a very morbid conversation. I don't envy life insurance salesmen's lives, right? They're going around talking about people passing away, right? And they're making money off of it. So again, you mentioned this. So again, it's a product that you buy. You pay a monthly or quarterly or annual premium, and in return, this company will give you some sort of death benefit. It could be $5,000. It could be $5 million. I mean, it could be all over the place as far as what that death benefit is. And whatever that death benefit is dictates what the premium is. Also, what dictates what that premium is, believe it or not, what kind of shape you're in. If you're healthy, weight, right? If you're a smoker versus non-smoker, they take basically a physical, and that's how they determine what you pay for this life insurance. Now, one of the perks of life insurance, though, is if something does happen to you, your heirs also get this money tax-free. So for some people, it can be a pretty valuable estate planning tool. But you know, that's typically in the higher net worth sectors, but definitely something that can be a useful benefit. But there's also, within this life insurance, not all policies look the same. So there's term life insurance, which basically you pay a premium for literally a set number of years, 10 years, 20 years, 30 years. And then if nothing happens to you over that time frame, typically the policy will lapse, or you can re-up it and you know, pay more. And then there's permanent insurance, like whole life, that by putting money into these policies, you're actually building up a value of something you could cash in later, even if something doesn't happen to you. Now, we just generally speaking, we don't like these permanent policies for the average day person because the fees can be rather expensive. And I don't like that life insurance salesmen pitch these as investment vehicles, because in my opinion, there's a far better way, a more efficient way to invest versus using life insurance. But that's a whole nother topic for another show. I guess the takeaway, though, Jake, you made a good point. It should be used to be paying off significant debt, taking care of your heirs from an income lifestyle in there, and replacing, you know, wages, right? So if you have significant debt, taking care of your heirs, and then I guess also replacing your income are why typically people purchase life insurance. Is there anything I missed there? I know, again, all these subjects today could be their own shows, but today we're going to kind of go on a high level of managing risk.
Yep, that's that's really good, Jake. And one other thing that I wanted to add, especially, you know, as we look towards someone that's more high net worth or ultra high net worth, they might have estate taxes that come into play upon death. And that could be, you know, term life or permanent life. It could be used to help fund the estate tax payment that is needed to be made. So there's all sorts of various strategies that you can implement for life insurance. But to your point, you just got to be very careful. Typically, it's someone selling a product is getting a big commission on it, and it might not always be in your best interest. So just make sure you read through the product, make sure you work with a fiduciary that truly is acting in your best interest while reviewing different types of life insurance policies.
Yeah, exactly. So be careful out there. Again, I'm not saying all life insurance salesmen are bad, but you got to understand they're not necessarily acting in your best interest. So it's kind of like when you go buy a car, Jake. And I know you bought a car from a personal friend, but if you go to a car lot, I don't expect the car salesman to be acting in my best interest. I expect him to sell me a car, right? But it's on me, the consumer, to ask questions, do my own research, and be informed before I step foot on that lot. So before you go and talk to an insurance agent, again, the good news with Falcon Wealth Advisors is we're not going to try to pitch you a product. So it pays to come talk to us. We're going to give you our opinion of what we think you need, knowing that we're not going to charge you because we're not the ones selling you the product. So something to think about there. Good point, Jake. What about our next subject on managing risk? And it's kind of the opposite of that. It's longevity risk. And that's saying that you may need to go to a nursing home. So a lot of people inquire about long-term care insurance. Jake, why don't you talk a little bit about long-term care insurance for us?
Sure. Similar to life insurance, a long-term care policy is structured where you would pay a monthly premium. And there's all sorts of different ways that they structure these products, but generally speaking, you know, you pay your monthly premium into a product. Well, that product is there for if you can't do 2 out of the 6 daily living activities, which can be described as bathing yourself, dressing, going to the bathroom, eating, transferring from, you know, your bed to a chair, things like that. If you can't perform at least 2 out of the 6 of those on a on a daily basis, then you could actually start getting a long-term care benefit if you have one of these products in place. Now, typically, there's something called an elimination period, which it could be 60 days, it could be 90 days. Typically, they're 90 days, but that means, let's say you're in a place where you can't do 2 of the 6 daily living activities and you need help. Well, you would have to wait 90 days and still not be able to do those activities before you would actually get your long-term care benefit, where they would start paying you a monthly income to help fund some of these expenses that you're incurring because you need some help, right? So, there's all sorts of ways that they can structure these long-term care products. Traditionally, it was a use it or lose it deal where you would pay your monthly premium and then you either, went into some sort of long-term care facility or needed some sort of long-term care. And if you didn't, then, you just paid those premiums and you didn't get the benefit, similar to term insurance, right? Now they're coming out with more and more products that are hybrids. Essentially they're combining a few different things. So an example is like using whole life insurance or the permanent insurance you talked about with a long-term care rider. But similar to the previous topic, you just want to be careful because there's a lot of fees that are virtually hidden from administrative expenses, et cetera, within the product. So you just got to be careful because they're combining a few different things, and those few different things are going to have their own expenses. So you just got to be careful.
That's good. Thank you, Jake. And there's 2 important points I want to make here with long-term care insurance. And number one, with our clients, we typically like to see if you can self-fund any type of elder care need before going and buying this long-term care. I think an insurance salesman's going to try to sell you a product first before seeing if you can afford it. A lot of people, I think, have ingrained in their brains that if they go to a nursing home or a long-term care facility, that they're going to lose all their money and be wiped away. No, I mean, if you have $2, $3, $4, $5 million, whatever it is, you probably have enough. And again, we'd have to look at your plan first, but you might have enough dividends and interest and growth in your account to simply pay rent and not deplete your assets. So that, in my opinion, would be far advantageous than going and buying an insurance product. Certainly the use or lose it policy, because again, then you might just literally be wasting your money because you may never need it, or some of these other hybrid policies that come with a lot of hidden fees. And the second point I wanted to make here is that you have to remember these life insurance companies aren't in business to give you benefits. They're in business to collect premiums and make money. So if these were good policies where the policy owner came out ahead, then the life insurance company would go out of business. So you have to remember that life insurance companies are doing it banking on that you're not going to use the policy, right? So they're betting on that you're going to pay them all this money and not get the benefit. That's how they make money. So you got to go into it realizing that you're doing it because you want to manage a risk, and maybe you do have the risk of running out of money, right? Or maybe you do want to protect your nest egg and you want to give more to your kids and you don't want to pay rent to a place. But you just got to be careful. You have to recognize that you're buying a product that's designed not for you to benefit, believe it or not. It's designed for the insurance company to benefit. So you got to be careful of that. It's very important. And again, don't think that you're going to necessarily deplete all your assets if you go into one of these places. Many times our clients just pay rent, right? And they're fine. And they don't deplete their assets. That's what hopefully we want to start with.
Right. And good point. I mean, if let's say that you're a household that's spending, $12,000 a month, right? $144K a year. Well, let's say that one of you goes into a long-term care facility, or both of you, you might pay rent that's $80 to $100K a year or incur expenses through that. But you got to realize that you most likely could sell your home because you're going to be in that facility for a while. There's various things that come into play where, you might incur a lot of expenses paying rent to those facilities. But those facilities are most likely paying for, that rent includes your food, right? It includes drinks, not all sorts of drinks, but, it includes a lot of
beverage, your transportation. In many cases, they'll take you to Walmart or the doctor.
Exactly.
So yeah, you're right. And you don't have a mortgage, or you don't have a house and property taxes and home insurance. Like you probably might not even have a car. So you don't have any of that expenses that go with owning a car. So you're right. So you want to think about all those things. And again, you don't want to worry about being wiped out. Now, that's certainly a concern. And if that is a concern, we need to talk about it. But the default shouldn't start with long-term care. That should be, again, a way to manage a risk. The default should be, can you afford it out of pocket? And do we have a plan for that first? Another quick point on that is the horrible thing about these things is sometimes they'll also change the rules on you during the policy period, which to me is crazy that they can do that. But I've heard of instances where they do that. They start to raise your premiums quite a bit higher when you get older, or, you know, don't cover as much forever. So you got to be careful because, again, the policy could change on you. And, you know, if you get one of these things in your 50s, you want to pay premiums for 30 years on something you may not ever need? That's tough.
Right, good point. And the typical time to look to get long-term care is around 60 to 65. But again, it can vary, right? You might have family history with a lot of longevity, and you know, unless you incur a crazy accident, then you might delay that, right? So it all depends to your financial plan.
Yes. Yeah, and that's key here, and we're going to keep defaulting to that. You just always go back to your financial plan, meet with your wealth advisor, your financial planner to talk about these things. Very good. The third one, Jake, which is a big one, is health insurance. Can you talk a little bit about health insurance? I know that we could go on for 30 minutes about health insurance, but we won't today. But talk a little bit about health insurance and why it's important as far as managing risk.
Sure. Yeah, a lot of people, it's a very common type of risk management. A lot of people have health insurance, right? So they know quite a bit about it, but especially if you incur a lot of health expenses, for example, you might not want to be in a high deductible health plan. Whereas if, you're very healthy and you're a younger individual, you might be into a high deductible health plan, which is simply, for an individual, if your annual deduction or deductible is $1,400 or more, or for a family, if your deductible is $2,800 or more, then you could be in a high deductible health plan. Now, I want to touch on the benefit of that, and it's not so much insurance related, but you can actually utilize a health savings plan and HSA, health savings account, and you could get a triple tax benefit and invest into an account like that, where you can potentially get a tax deduction on the way in. Those dollars you can actually invest typically, and they can grow tax deferred. And then when you go to use those funds for health expenses, for qualified health expenses, you can actually take it out tax free. So that was a big point that I wanted to make for health insurance and the different health plans. And also, especially if you're looking to retire soon, I think it's really crucial to understand and know the difference in how you're going to transition from getting health insurance through your employer. If you retire before age 65, well, you might need to go on COBRA, which is extended health insurance through your employer, essentially, or you might go to the secondary market and need to get health insurance. So you just need to understand what type of position you are and what timeline you are in your life, and understand the different health insurance plans out there.
Yeah, good one, Jake. So this one's key. This one is not like life insurance or any, and by the way, quick note on life, many of our clients in their 60s don't have life insurance anymore because they don't have debt, they're retired, and their kids are grown and gone. So they don't feel like they need it. But health insurance is one of the ones that you kind of always need to have, whether that's through Medicare, your company, or out on the open market. But just know you can retire at 55 and potentially go out there and get health insurance. You just need to go and meet with someone that does this. And so they can shop the open market, and you can make sure you understand what it's going to cost, what it's going to cover, and what that plan is. And then Jake and I can input that into your financial plan and make sure that it lines up with everything that you need. You don't want to roll the dice on this one, though, and not have health insurance. Because again, God forbid something catastrophic happens, or you need a surgery or something, and you have to pay for it out of pocket. You don't want to get wiped out by that, or you don't want to have to default on your medical bills or go down that road. So the key is making sure you've got proper coverage. Like Jake says, look at the low deductible versus high deductible, see which one makes most sense for you financially and medically speaking. And then again, work with an outside professional. If you're going to be leaving your company, that's the time to engage with an independent health insurance agent, which again, we can refer you to, and so that they can look at all of the options for you and help you shop accordingly. So that's a good one. Health insurance important, something that you really can't sleep on. You got to have it, in my opinion, just to make sure that, again, that you're covered. That's a quick way to blow up a financial plan, is to go and have surgery and you're not properly covered. So good. Our next one here, we got two more to go, Jake, but our next one is property and casualty insurance. You want to talk a little bit about that?
Sure. Yeah, I think this is one that kind of gets swept under the rug quite a bit. And a lot of folks, and I can even think of my personal life, you might get a homeowner's policy and you don't really look at it, right? You don't really know fully what it's covering. And I think that's really crucial, especially depends on the type of, where you live in the United States or maybe outside the United States. But for home insurance specifically, you want to make sure that your coverage amount is at the very, very bare minimum 80% of what your replacement cost is. For example, if you had if there's a tornado that happened, right? We're in Kansas, it happens. If there's a tornado and it wiped out your home, well, what's it gonna cost for you to rebuild your home to the same standard? Replacement costs increase, right? So they go up over time because labor increases, right? Supplies, materials increase. So you just want to make sure that you're covering that. But really, if you're trying to be prudent, you should have 100% of coverage for a homeowner's insurance policy of your replacement cost. So you just want to match those up. And then, looking at auto insurance, you just want to make sure, depending on the type of car you have, that you have enough coverage. I think liability when it comes to cars is really crucial because car accidents happen. People unfortunately get really injured in car accidents, and lawsuits can occur. Especially with a lot of our clients, they might have, nicer vehicles, right? They could be luxury vehicles. And if you're in a car accident, you have a higher chance of getting sued, because the everyday individual is going to look at you and say, oh, they have money, so they're going to sue you. So liability coverage, especially with luxury vehicles, is crucial. So you just want to make sure that you are getting fully covered on that aspect. A typical policy is what they call 100, 300, 100, which is essentially 100K of coverage per individual with a 300K of liability coverage max per accident, and then 100K of property damage coverage. So you just want to make sure, though, that you are covering your bases with that.
And Jake, how often should people review their property and casualty insurance?
Yeah, I would probably review it. Well, of course, anytime you get a new vehicle or change homes or buy a new home, anytime like that. But, if you maintain everything, I would definitely review it every 2 years or so. You just want to make sure that, there isn't a certain company out there that's more competitive that you could then switch to and lower costs. You just want to make sure that you're reviewing it every so often.
Yeah, good. Yeah, because I think especially, and don't forget, if you buy jewelry, right? You get a wedding ring or a nice watch, you want to make sure you're adding that to the list of things that you have and declaring that with your agent, because a lot of that stuff can be covered, but you want to make sure you've got proper receipts. If you artwork, right, all that stuff should be reviewed and bought. Another thing to not sleep on, in my opinion, if you're going to spend money on a nice home or a vehicle, you want to make sure it's properly covered, because like Jake, you mentioned, and we're not trying to scare anybody, but accidents happen. And, that again is another way to hurt a financial plan, is if you're not properly covered, then you could have to end up dipping into your retirement to just get your lifestyle back to the way that it was. Or the flip of that is, like you already kind of alluded to, you may be overpaying for coverage, or you may be overcovered in some instances. So again, definitely something you want to look at. You want to work with an agent that ideally, and again, we feel this way, that's an independent agent, I like, that can go and shop different carriers and then make sure that they walk through the policy and talk about the coverage and explain it to you. And again, you as a consumer, you got to do your homework a little bit here and understand exactly what you're paying for and what it's covering in there. Perfect, Jake. And our last topic today, real quick, I want to talk about the dreaded annuities, which we're not big fans of. A lot of advisors, you got to be careful, a lot of advisors pitch annuities. So Jake, why don't you talk a little bit about what they are?
Sure. Yeah, an annuity there's various ways to structure this certain product. but essentially it is designed to help supplement retirement income. And you could pay monthly premiums into this certain product. You could do what's called a single premium annuity, a SPIA is what they call it. So there's various ways to structure it, but essentially it's designed to help supplement retirement income. You could have a qualified annuity, which you could contribute, and then if there's any growth associated, it could be tax deferred until you go withdraw the funds. You could have a non-qualified annuity. You could have one that's fixed, where you know what dollars you will receive when you go withdraw funds from it, but there's no potential for growth, right? Or on the flip side, you could have a variable annuity, which typically are designed to match to some degree a certain investment index. So you could think the S&P 500, for example. You could have an annuity that's tied to that. But you got to keep in mind, it's a product, right? There's pros and cons. And with certain products like that, you're going to be capped on the upside potential. And then you're also going to be capped most likely on the downside. So you just want to make sure that it makes sense, because you might be better off investing in a different product or just investing directly with stocks and bonds and trading options, as opposed to getting stuck into one of these products. Because a lot of people don't realize this, and it's kind of hidden in the contract and paperwork that you look at when you're going through an annuity process. But there could be surrender fees or charges where you could essentially get locked into a product for 6 to 10 years, and you can't pull funds out of it for that period of time. And if you do, there's going to be very high fees. And on top of those fees from the insurance company, you could also get taxed as ordinary income. Plus, if you're younger than age 59 and a half, there could be a 10% penalty. So there could be 10% penalty, taxes, and surrender charges. So, there's obviously a place in someone's financial plan for it, depending on your financial plan. But for the majority of folks, especially folks that we work with, it's typically not in their best interest, but it all depends.
Right. That's a good point. And you got to remember, it's fees, fees, fees. The advisor that sold you to it is going to get paid. The insurance company that's packaged the products is going to get paid. And if it's a variable annuity and there is a investment option inside, whoever's investing that money is going to get paid. And so that's typically why we don't like them. And then the other point you made, Jake, is restrictions. Like, you could put money in there, and if you need to turn around and get it back out, you might have a liquidity issue, might not be able to do that. The key takeaway here on these annuities, you got to remember, these annuity companies are in it to make money. And so they're not necessarily acting in your best interest. And so you got to be very careful with them. I've never liked annuities in my career. Sure, there's probably some unique situation where they can make sense on a one-off situation, but broadly speaking, I personally, and again, this is my opinion, believe there's far more efficient ways to invest, and there's far more efficient ways to protect and manage risk in your portfolio. And annuity, in my opinion, is not the way to do it. And
Right.
Again, so again, you got to remember, the whole theme of this show is managing risk. And some insurance, you got to have health insurance, you got to have that property and casualty. To me, those make a lot of sense. The other ones may make sense, but again, you got to understand that the insurance company's in it to make money. So they're not selling a bunch of policies and giving out a bunch of money, or they'd be out of business. That's a losing business venture for them, right? They want to sell a lot of policies and not give out any money. That's what they're trying to do. And so you got to understand that and be an informed consumer as you go into it, and understand what you're exactly signing up for before you sign up. Do you have something, Jake, you wanted to add here?
Yeah, one last thing on annuities. People's life, it's very fluid, right? We know that it changes all the time. And, a byproduct of that is, okay, well, their spending might change, right? And if you're in a fixed annuity and you're receiving fixed payments, you could be someone that's, is very adverse to the market and doesn't like, fluctuations over time. But at the end of the day, if you can't pull out more income from the annuity because it's fixed to sustain your lifestyle, well, that's a big problem, right? So you just got to be very careful that you're not putting all your eggs in the same basket with a fixed annuity where you're locking yourself in, and that's the income you're going to get for a period of time, right? So you just got to be careful.
Yeah, absolutely. You got to be careful on that. And again, you typically get the slickest salesman in the industry selling those annuities because they get paid a lot of commissions. So you want to be careful with that. Again, be informed, talk with a fiduciary advisor. But again, even sometimes fiduciaries will try to pitch those annuities. You just want to be careful. You want to understand what you're getting yourself into. To us, a very pure, clean way to do it, again, is to buy individual stocks and bonds and trade options, have appropriate amounts in cash or in treasury bonds, right? Or I bonds, right? All things that we've talked about on Upticks. And that's the way we prefer to protect a portfolio. And then we use health insurance, right? Or long-term care if it makes sense. Not really that much of it, but if it does, right? Make sure your property and casualty is set up to help shield some of your net worth or your portfolio in case of a catastrophic event. But you want to be aware, you want to know what's going on, you want to explore your options. Certainly don't hesitate. If you have any questions for myself or Jake or anyone on our team at Falcon Wealth Advisors, or you want us to review any type of insurance policy that you may have, let us know. We're happy to do that. Again, we're not pitching insurance here. So again, you're going to get a fiduciary mindset around it and an opinion of someone that's not trying to sell you something, which I think is very important. All right, very good. Jake, thank you. I know it was a longer episode than normal. Thank you so much for joining me on today's show. Thank you all for tuning in. If you haven't already liked and subscribed to our content, please do so. That's the number one way I think that people get to see our show. Another quick update, Corey will be joining Upticks more often now. We're going to shut down In the Money Insight, and we're going to pool our efforts into one show at Falcon Wealth Advisors. So we're excited to have Corey on more episodes. And Jake, we're excited to have you on more episodes as well.
Awesome. Thank you, Jake.
Yeah, thank you again.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.